Are you looking for peace of mind at your doorstep? Look no further. With the Blink Video Doorbell, your home's entrance is always within your control. Check out the link in the video description to learn more and get your Blink Video Doorbell on Amazon. Your home is in your hands.
Homeowners in Texas, Florida, and Tennessee have now become reluctant to sell their properties because they're currently on low mortgage rates, and a move to any new home would mean borrowing at rates likely more than double their previous. Over the last 2 years, the U.S. Federal Reserve's hiked interest rates in an effort to curb inflation. In the process, mortgage rates have been pushed to their highest levels in 4 decades. It means there have been higher housing costs for buyers while home prices continue to rise. Homeowners that were locked into lower mortgage rates are essentially deterred from selling and facing new loans at more than 7% interest, investor and Shark Tank personality Kevin O'Leary said. That was unprecedented in terms of the pace, O'Leary said to Newsweek. O'Leary noted that approximately 90% of homes have mortgages with rates below 6%. If those people were to sell their homes now, they would be now facing a 7.5% mortgage versus 3.5%. They have no incentive to sell their homes, O'Leary explained. So you've got an artificially low number of existing housing units not coming on the market. That's particularly evident in Florida, Texas, Tennessee, and other markets. Wealthy retirees are moving from high-tax states such as California, Massachusetts, New Jersey, and New York to places with lower taxes and living costs such as Miami, Florida, and Austin, Texas, increasing demand and driving up prices in these markets. The shift towards remote work, accelerated by the pandemic, has also increased demand in the South and Sun Belt regions, as people seek better living standards away from urban centers. If you were looking at a map of where housing is particularly strong, it coincides or correlates with more attractive tax policy, O'Leary said. If you can move 100 miles out of the city or 200 miles away from where you work, you live in a better location for many reasons: better housing, better schools, a better lifestyle. O'Leary went on. So those smaller towns and those jurisdictions which weren't ready for a boom in housing find themselves in exactly that huge demand. And this is the nature of a digital economy. O'Leary said he was surprised that high mortgage rates haven't dampened housing demand, attributing it partly to historical norms where rates were in the 6 to 7% range. He emphasized that the rapid pace of the Fed's rate hikes was unprecedented and unexpected, but was also surprised that it did not dent the demand for housing. I don't think anybody saw that coming, he said. It doubled or tripled the cost of mortgage and had no effect on demand. One way of explaining that dynamic was that historically rates had been in the 6% and 7% range. Many housing market booms have occurred during periods where rates were higher than that, O'Leary said. But to have the Fed raise rates in an unprecedented speed as we saw, that was really unique. The majority of housing is extraordinarily buoyant through an unprecedented period of rate hikes, and so for those of us who analyze this every day as we try and deploy capital, that was a surprise.